Picture this scenario. You're scrolling through social media at 2 in the morning, watching someone your age post about their latest vacation to Bali, their brand new Tesla, or their downtown apartment that probably costs more than your entire annual salary. And there you are wondering how they afford all this while you're calculating whether you can splurge on the name brand cereal this week. Sound familiar? Well, what if I told you there's a specific skill that could bridge that gap between barely scraping by and actually building real wealth? Most people think the stock market is some mysterious casino where only Wall Street wolves and trust fund babies can succeed. But here's something that might surprise you. The stock market isn't just for people who wear expensive suits and speak in financial jargon. It's actually the most accessible wealth building tool available to regular people like you and me. My name is Nick, and I spend way too much time studying how ordinary people transform their financial lives through smart investing. If you've ever wondered how to stop watching your money slowly lose value in a savings account and start making it work harder than you do, make sure to hit that subscribe button and give this video a thumbs up if it helps you finally understand what everyone else seems to know about building wealth. And remember, I am not a financial advisor. The content in this video is for educational and entertainment purposes. Now, before we dive into the mechanics of stock market investing, let me ask you something. When you think about your financial future, what comes to mind? Maybe you picture yourself still working at 70 because you can't afford to retire, or perhaps you imagine finally having enough money to stop worrying about every purchase. Guess the truth is, your financial destiny isn't determined by luck or inheritance. It's determined by understanding how money actually works in the modern economy. Here's what most people don't realize about wealth building. The gap between the financially secure and the financially stressed isn't usually about income levels. I know people making six figures who are completely broke, and I know people earning modest salaries who are quietly building substantial wealth. The difference comes down to one fundamental concept that separates those who thrive from those who barely survive. They understand that in today's economy, your money needs to be working for you, not just sitting there looking pretty in a checking account. Let's talk about why this matters more than ever in 2026. The cost of everything has exploded over the past few years. Housing, groceries, gas, insurance, you name it. Meanwhile, the average savings account is paying you maybe 0.5% in interest if you're lucky. That means your money is literally losing purchasing power every single day it sits in the bank. It's like watching your wealth slowly evaporate while you do nothing about it. But here's where things get interesting, and this is something that will probably blow your mind. While your savings account is paying you practically nothing, the stock market has been creating millionaires out of ordinary people who simply understood how to harness its power. The S&P 500, which tracks the 500 largest companies in America, has delivered average returns of around 8 to 10% annually over the long term. That might not sound exciting until you realize what compound interest can do with those numbers. Let me paint you a picture of what this actually means in real terms. If you're 25 years old and you start investing just $300 every month in a basic index fund, assuming that historical 8% return, you'll have over $800,000 by the time you're 65. That's from investing $300 a month. Most people spend more than that on coffee, streaming services, and impulse purchases they forget about a week later. The beautiful thing about stock market investing is that it's not about timing the market perfectly or picking the next big winner. It's about understanding that when you buy stocks, you're literally buying pieces of the most successful companies in the world. When you own a share of Apple, you own a tiny slice of one of the most profitable companies in human history. When you own a piece of Microsoft, you're benefiting from their dominance in software and cloud computing. These companies employ some of the smartest people on the planet and spend billions of dollars figuring out how to make more money. Why wouldn't you want to be along for that ride? Here's something that separates successful investors from everyone else, and it's simpler than you might think. They understand the difference between speculation and investing. Speculation is buying something because you think someone else will pay more for it later. It's hoping that a stock will go up because of hype, trends, or market momentum. Investing, on the other hand, is buying a piece of a business because you believe that business will be worth more in the future due to its ability to generate profits and grow over time. Most people approach the stock market like it's a lottery ticket or a casino game. They buy whatever stock is trending on social media, chase the latest hot tip from their cousin who claims to have insider knowledge, or panic sell when the market has a bad day. This is exactly backwards from how wealth is actually built through stock investing. The people who build serious wealth through stocks treat it like what it actually is, which is buying ownership stakes in profitable businesses. Now, I know what you might be thinking, Nick, this all sounds great in theory, but what about market crashes? What about losing money? These are legitimate concerns, and anyone who tells you stock investing is risk-free is lying to you. But here's what's fascinating about market downturns that most people don't understand. Every major market crash in history has been followed by a recovery that brought the market to new highs, every single one. The 2008 financial crisis was terrifying for investors, but if you had simply held your investments through that downturn, you would have recovered all your losses and made substantial gains in the years that followed. The pandemic crash of 2020 felt like the end of the world, but the market recovered within months and went on to hit record highs. The key insight here isn't that crashes don't happen, it's that they're temporary setbacks in a long-term upward trend. This brings us to one of the most important concepts in investing, which is time horizon. If you need your money next year, the stock market probably isn't the right place for it. But if you're investing for goals that are 5, 10, or 20 years away, short-term volatility becomes completely irrelevant. In fact, market downturns become opportunities to buy more shares of great companies at discounted prices. The data on this is absolutely compelling. Like if you look at any 20-year period in stock market history, you'll find that patient investors have been rewarded. Not some of the time, not most of the time, but literally all of the time when we're talking about broad market index investing. This isn't a guarantee of future performance, but it's the closest thing to a guarantee you'll find in the investing world. Here's where most people get stuck though. They understand intellectually that long-term investing works, but emotionally they struggle with the day-to-day fluctuations. They check their account balance obsessively, panic when it's down, and feel euphoric when it's up. This emotional roller coaster is exactly what prevents most people from achieving their financial goals through investing. Successful investors develop what I call investment discipline. They understand that their account balance will fluctuate, sometimes dramatically, but they stay focused on their long-term goals rather than short-term market movements. They automate their investments so they're consistently buying shares regardless of market conditions. Most importantly, they educate themselves about what they own so they can stay confident during turbulent times. The foundation of building wealth through stocks isn't about having some secret formula or insider knowledge. It's about understanding a few basic principles and having the patience to let them work. Think of it like planting a tree. You don't plant an oak tree today and expect to sit in its shade tomorrow. But if you plant it today and take care of it consistently, in 20 years, you'll have something substantial that provides value for decades to come. Now, let's talk about what you're actually buying when you purchase stocks. This is where a lot of people get confused because they think they're just buying numbers on a screen that go up and down randomly. But every stock represents real ownership in a real business that employs real people and generates real profits. When you buy a share of Coca-Cola, you own a tiny piece of a company that sells over 2 billion servings of beverages every single day. When you own Disney stock, you're part owner of theme parks, movie studios, and streaming services that generate billions in revenue. The reason stock prices move up and down isn't because of some mystical force or because traders are having good or bad days. Stock prices move based on what investors think those underlying businesses will be worth in the future. If a company is growing its profits and expanding into new markets, investors will generally be willing to pay more for shares of that company. If a company is struggling or facing new competition, investors might decide those shares are worth less. This is why understanding the basics of business evaluation becomes so important for investors. You don't need an MBA or a finance degree, but you should understand fundamental concepts like revenue growth, profit margins, and competitive advantages. Revenue is simply how much money a company brings in from selling its products or services. Profit is what's left over after paying all the expenses. A competitive advantage, often called a moat, is what prevents other companies from easily stealing that business. Let me give you an example that makes this concrete. Apple has massive revenue from selling iPhones, iPads, and other devices. They also have impressive profit margins because people are willing to pay premium prices for Apple products. Their competitive advantage comes from their ecosystem, where all their devices work seamlessly together, making it inconvenient for customers to switch to competitors. These factors combined explain why Apple stock has been such a wealth creator for long-term investors. But here's where it gets really interesting for beginner investors. You don't actually need to analyze individual companies at all if you don't want to. You can buy something called an index fund, which automatically gives you ownership in hundreds or even thousands of companies at once. It's like buying a pre-made fruit salad instead of having to pick each individual piece of fruit yourself. The most popular index funds track something called the S&P 500, which includes the 500 largest publicly traded companies in America. When you buy an S&P 500 index fund, you're instantly diversified across technology companies like Apple and Microsoft, healthcare companies like Johnson & Johnson, financial companies like JP Morgan Chase, and consumer goods companies like Procter & Gamble. Your success isn't tied to any single company, but rather to the overall success of American business. This is probably the closest thing to a free lunch that exists in investing. You get professional diversification without having to do any research or make any individual stock picks. You get exposure to the innovation and growth of hundreds of companies with a single purchase. And historically, this approach has outperformed most professional money managers who spend their entire careers trying to beat the market. The fees on index funds are ridiculously low too, often less than 1/10 of 1% annually. Compare that to actively managed mutual funds that might charge 1 or 2% per year, and you start to understand why those fee differences compound into massive amounts over decades. Paying an extra 1% in fees might not sound like much, but over 30 years, it can literally cost you hundreds of thousands of dollars in lost returns. Here's something that might surprise you about successful investing. The most important decisions aren't about which specific stocks to buy or when to buy them. The most important decisions are about how much to invest, how often to invest, and where to hold those investments from a tax perspective. These unsexy administrative details make a far bigger difference in your long-term results than trying to pick the next Amazon or Tesla. Starting with how much to invest, the general rule of thumb is to invest at least 10 to 15% of your income for retirement. If that sounds like a lot, start with whatever you can afford and gradually increase it over time. Even investing $50 a month is infinitely better than investing $0 a month. The key is building the habit and letting compound interest work its magic over time. How often you invest matters more than most people realize. Rather than trying to time the market by making one big investment when you think conditions are perfect, successful investors use something called dollar cost averaging. This means investing the same amount of money at regular intervals, regardless of whether the market is up or down. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this averages out to a reasonable cost per share without requiring you to predict market movements. The account type you use for investing can make an enormous difference in your long-term results due to taxes. Traditional brokerage accounts are subject to capital gains taxes when you sell investments for a profit. But retirement accounts like 401ks and IRAs offer significant tax advantages that can supercharge your returns over time. A Roth IRA might be the most powerful wealth building tool available to young investors. You contribute money that's already been taxed, but then all your investment gains grow completely tax-free forever. If you start investing in a Roth IRA in your 20s and it grows to $1 million by the time you retire, you can withdraw all of that money without paying a single penny in taxes. The government basically gives you a lifetime pass on taxes for your investment gains. The contribution limits for 2026 allow you to put up to $7,500 per year into a Roth IRA if you're under 50. That might sound like a lot if you're just starting out, but it breaks down to less than $600 per month. Many people spend more than that on restaurants, entertainment, or subscription services they barely use. Here's where the psychology of investing becomes crucial, and it's something that separates successful investors from everyone else. Most people have this backwards relationship with stock prices where they get excited when prices go up and depressed when prices go down. But think about this logically for a second. If you're planning to be a buyer of stocks for the next several decades, shouldn't you actually prefer lower prices over higher prices? When you go to the grocery store and see that your favorite items are on sale, you don't get upset about it. You get excited because you can buy more for the same amount of money. The same logic should apply to stock investing, but somehow our emotions get in the way. When stock prices drop, that's essentially the entire stock market going on sale. Yet most people respond by wanting to sell rather than buy more. This emotional challenge is exactly why automation becomes so important for successful investing. When you set up automatic transfers from your bank account to your investment account, you remove emotion from the equation entirely. You're buying regardless of how you feel about the market that particular month. You're buying when prices are high, when prices are low, and everywhere in between. This consistency is what allows compound interest to work its magic over time. The beautiful thing about starting your investing journey in 2026 is that technology has made it easier and cheaper than ever before. You can open a brokerage account online in minutes, often with no minimum balance requirements. You can buy fractional shares, which means you can invest in expensive stocks like Amazon or Google even if you only have $50 to invest. Many brokerages offer commission-free trading on stocks and ETFs, eliminating one of the traditional barriers to getting started. But here's what technology can't do for you. It can't provide the patience and discipline required for long-term wealth building. It can't prevent you from making emotional decisions during market volatility. It can't force you to consistently invest month after month when life gets busy or expensive. These human elements remain the most important factors in investment success. The investors who build serious wealth through stocks share certain characteristics that have nothing to do with intelligence or luck. They start early, even with small amounts. They invest consistently, regardless of market conditions. They keep their costs low by choosing simple, diversified investments. They ignore short-term market noise and stay focused on their long-term goals. Most importantly, they educate themselves continuously about investing principles so they can stay confident during inevitable market downturns. If you're still with me at this point, congratulations. You've already demonstrated more commitment to understanding investing than 90% of people who say they want to build wealth but never actually take the time to learn how. Most people would rather spend 3 hours researching which Netflix show to binge next than spend 30 minutes learning about the financial vehicle that could literally change their entire life trajectory. Now let's get practical about what this actually looks like in 2026. The first step isn't picking stocks or timing the market or finding some secret investment strategy that Wall Street doesn't want you to know about. The first step is simply opening a brokerage account. And yes, it's really that straightforward. You can do this from your phone while sitting on your couch in your pajamas. No suit required, no secret handshake, no minimum net worth verification. The major brokerages in 2026 have made this process incredibly user-friendly because they want your business. Companies like Fidelity, Charles Schwab, and Vanguard offer commission-free stock trades, and have eliminated most of the fees that used to make investing expensive for small accounts. You can literally start investing with whatever amount you have available right now, whether that's $50 or $5,000. Here's something that would have shocked investors from previous generations. You don't need to buy whole shares anymore. If you want to own a piece of Amazon, but the stock costs $3,000 per share, you can buy a fractional share for whatever amount you can afford. Want to invest $100 in Amazon? No problem. You'll own a tiny slice of that company proportional to your investment. The stock market isn't some mystical realm reserved for people who went to fancy business schools or inherited trust funds. It's simply the most powerful wealth building tool available to anyone with the discipline to use it consistently over time. Start with whatever you can afford. Automate your investments, choose low-cost index funds, and then do the hardest part of all, which is absolutely nothing for the next 20 years. Your future self will thank you for finally taking action instead of just watching everyone else build wealth while you stayed on the sidelines.